Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Tuesday, August the 18th, 2026, and we've got a packed show. Retail earnings season hits its peak this week with Home Depot reporting today, Walmart on Thursday, and the FOMC minutes dropping Wednesday. Let's get straight into it. Lizzie, futures are mixed. The S&P 500 is sitting on 3 consecutive weekly gains, but retail sales dropped 0.6% in July, and inflation expectations are climbing to 4.3%. How fragile does this rally feel?
Morning, Robert. Honestly, it feels like a rally that's earned some skepticism. 3 weeks of gains is a solid run, but the foundation underneath it is starting to show cracks. That combination of weakening consumer spending and rising inflation expectations is essentially a stagflation signal, and markets are leaning heavily on this week's retail earnings to either validate the optimism or force a reality check. On the technical side, SPY and the S&P 500 are both sitting in neutral territory right now. Momentum is still technically positive with the MACD elevated, but there's no fresh directional conviction coming from the charts, which tells you the market is genuinely waiting for a catalyst before committing to the next move.
Home Depot reports today from Mate. Estimated revenue of $47.2 billion and EPS around $4.73. Last quarter, they barely beat by less than 1%. What does Home Depot actually need to deliver to move the market?
The bar for Home Depot isn't just a beat. It's a beat with forward guidance that signals the housing-adjacent consumer is still spending. And given that the 10-year yield is near a 19-month high and housing has been under pressure, that's a meaningful ask. A miss or cautious guidance from HD could drag the entire consumer discretionary sector lower and reinforce those stagflation concerns almost immediately. Lowe's and TJX both report tomorrow as well. Lowe's with an estimated $26.2 billion in revenue, and TJX coming off an extraordinary 18% beat last quarter. So traders will be reading all three together as a layered read on the consumer across different spending categories.
Speaking of TJX, is there a different consumer story there compared to Home Depot or Lowe's, given they're more value-oriented?
Very much so. TJX is an off-price retailer, and in an environment where consumers are feeling squeezed by sticky inflation, that model tends to actually benefit from the stress rather than suffer from it. The underlying dynamic of consumers trading, down to TJX from full-price retail, is a durable trend in this macro environment. So the story is structurally different from a Home Depot, which depends more directly on housing activity and bigger-ticket discretionary spending. Last quarter's 18% beat sets a high bar, but the tailwind behind TJX is more resilient to a slowing consumer than most of its peers this earnings cycle.
Walmart reports Thursday with a $186.9 billion revenue target and EPS near $0.74s. The stock is down nearly 12% since its last earnings beat and trades at a premium 37x forward earnings. What do investors actually need to see to get excited again?
Walmart needs a beat and raise, not just meeting the numbers, but raising guidance convincingly. Because at 37x forward earnings, there's virtually no margin for disappointment. The fact that the stock is down nearly 12% since a quarter where they actually beat on EPS, revenue, and same-store sales tells you the market has been skeptical that the momentum is sustainable. So Walmart needs to show that US comparable store growth is holding above 3.5%, and that they're capturing share as consumers trade down. The same tailwind TJX benefits from. But Walmart needs to quantify it explicitly to get investors re-engaged at this valuation.
The AI spending theme is still running. Nvidia reportedly in talks to invest $3 billion into SoftBank's energy unit. Alphabet looking at Australian dollar bonds for AI infrastructure. Anthropic projecting up to $200 billion in revenue by 2028. Does this trade still have legs, or is the market pricing imperfection?
The structural build-out story is real and the capital commitments are genuine. But Applied Materials flagging a disappointing outlook this week is an important data point. When the equipment suppliers start signalling caution, it raises questions about the pace of capacity expansion and whether near-term demand matches the long-term projections. The AI infrastructure trade isn't broken, but the days of the market rewarding every AI headline indiscriminately are probably behind us. And from here, investors are going to need to see those projections, like Anthropic's $200 billion target, translate into actual revenue progress before re-rating further.
Steve, housing starts and industrial production both dropped this morning. Housing starts are forecast at 135 million against a prior reading of 1.427 million, which is a meaningful step down. What does a miss on housing data do to rate-sensitive sectors right now?
Robert, that prior reading of 1.427 million in June was itself a strong upside surprise against expectations of 1.31 million. So the market is already bracing for some payback, and a miss below the 1.35 million forecast this morning would add real pressure to rate-sensitive sectors, including real estate and banks, that are already feeling the weight of the 10-year yield approaching that 19-month high. The concern is that with inflation, expectations rising to 4.3%, and the Fed holding rates at 3.50% to 3.75%, the housing sector has very little cushion right now, and weaker starts data would reinforce the argument that higher for longer is genuinely starting to bite into new construction activity. Industrial production is also due this morning, though we're heading into that release without a published forecast or prior benchmark, so it may generate less immediate market reaction than the housing print.
Initial jobless claims come Thursday, forecast at 212,000 against a prior of 209,000. In the context of that surprise payroll contraction of 23,000, how important is Thursday's number for the Fed's September calculus?
It's quite important, Robert, because the labor market picture has become one of the central inputs for the Fed's September decision, and that surprise payroll contraction of 23,000 already did meaningful work in pulling the probability of a September rate hike down from 75% to around 32%. A claims number that comes in above the 212,000 forecast or continues trending higher would add further weight to the softening labor market narrative and likely push those hike probabilities even lower, which would be broadly supportive for risk assets including equities and crypto. The 4-week moving average is the figure worth watching more than any single weekly print because it smooths out the volatility and gives a cleaner read on whether the labor market is genuinely cooling or just experiencing week-to-week noise around what is still a relatively contained level.
Lizzie, the FOMC minutes from July drop Wednesday. Traders have already cut the September hike probability to around 25 to 32%. What are you watching for in those minutes that could actually shift rate expectations further?
The key thing to watch is the tone around the dissenting voices. We know 3 Fed members voted for a hike at the last meeting, so the minutes will reveal how much of the committee is genuinely on the fence versus firmly on hold, and whether the discussion around inflation persistence is hardening or softening. If the minutes show broader concern about inflation expectations becoming unanchored, which would align with that University of Michigan survey, showing 4.3% year-ahead expectations, that could push hike probabilities back up and reverse some of the rate relief that's been quietly supporting markets this week.
Let's move over to crypto. Bitcoin is holding just above $63,500, but spot ETFs shed $390 million last week alone and are down nearly $4.83 billion year to date. Is this a market finding a floor or just a pause in the bleed?
The technical picture is actually giving Bitcoin a modest edge here. We're seeing a bullish divergence set up, where price is sitting near recent lows around $63,500, but the underlying momentum is holding up better than price action alone would suggest, which points to a cautious buy signal rather than a continuation of the bleed. That said, the conviction is modest. This looks more like sellers losing steam than buyers rushing in. And with $4.83 billion in year-to-date ETF outflows and institutional buyers still largely on the sidelines, any recovery is likely to be slow and fragile unless the macro picture shifts meaningfully, particularly around that September rate hike probability.
What about ETH and Sol? Where do they stand right now?
Both are sitting in neutral territory technically. Ethereum around $1,094 and Solana near $75.70, with neither showing a compelling directional signal in either direction, which is a fair reflection of the broader uncertainty in the crypto market right now. Ethereum is down 37% year to date, and Solana 40%, both harder hit than Bitcoin, partly because institutional flows have concentrated in Bitcoin ETFs, while altcoins have faced persistent outflows and weak demand. The more interesting longer-term development is the shift among institutional counterparties toward evaluating tokens on actual revenue, fee generation, and on-chain activity, rather than market cap rankings, which is a healthier framework, but it doesn't provide a near-term catalyst when the macro headwind from a 3.75% Fed funds rate is still firmly in play.
That wraps up today's Morning Bell. Remember, this is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.